Today we're going to look at the company Pizza Royalty, headquartered in Canada and traded on over-the-counter OTC stock exchange under the ticker PZRIF. Please stay tuned for the important disclosure information at the conclusion of this video. The history of Pizza Royalty is a story of a local Toronto shop evolving into a cornerstone of the Canadian restaurant investment landscape. It all began on New Year's Eve in 1967, when founder Michael Overs opened a single 300-square-foot storefront at the corner of Wellesley and Parliament Streets in Toronto. Overs personally guided the company's growth for over 40 years, methodically expanding across Ontario throughout the 70s and 80s while building the brand's reputation for service and reliability. The most significant structural shift occurred in July 2005, when the company went public as the Pizza Royalty Income Fund on the Toronto Stock Exchange. This move allowed investors to share directly in the top-line system sales of the restaurant network through a royalty-based model. Shortly after, in 2007, the company made a major strategic acquisition by purchasing Pizza.TO, the leading pizza brand in Western Canada, which provided a massive foothold in Alberta and British Columbia. Following changes in Canadian tax laws regarding income trusts, the entity underwent its final major transformation on December 31, 2012, converting from a trust into its current corporate form, Pizza Royalty Corporation. Today, the corporation manages a royalty pool of over 800 restaurants across two iconic brands, maintaining its position as a top-line income stock that prioritizes steady monthly dividends for its shareholders. Pizza Royalty operates on a top-line royalty model, a structure that effectively separates brand ownership from the day-to-day complexities of restaurant management. The corporation itself does not flip burgers or manage staff. Instead, it owns the trademarks and intellectual property for two of Canada's most recognizable quick-service brands, Pizza and Pizza.73. These assets are licensed to the privately held Pizza Limited, which manages the actual franchise operations. In exchange, the Royalty Corporation receives a fixed percentage of gross sales, 6% from Pizza locations and 9% from Pizza.73, ensuring a steady stream of income that is shielded from the rising costs of labor and ingredients that typically squeeze restaurant profits. The company's market is predominantly Canadian, with a deep-rooted presence in Ontario through Pizza and a dominant delivery-focused footprint in Western Canada, particularly Alberta, via Pizza.73. While the vast majority of its 800 restaurants are domestic, the company has recently ventured into international territory with a master franchise agreement in Mexico, marking its first major step outside the Canadian border. The customer base is remarkably broad, spanning value-conscious families, late-night students, and corporate clients, all served through a mix of traditional storefronts and non-traditional locations like university campuses, sports arenas, and cinema complexes. By focusing on these diverse high-traffic channels and a robust digital delivery platform, the business maintains consistent cash flow to support its hallmark monthly dividends. The financial journey of this royalty entity began shortly after its inception as an income fund, initially relying entirely on the namesake brand that dominated the Ontario market. This original revenue stream provided a remarkably stable foundation, as it was tied directly to the gross sales of hundreds of locations rather than the individual store margins. A pivotal shift occurred just a year into this public history when the fund strategically acquired the leading pizza brand in Western Canada. This introduced a secondary, high-margin royalty stream that gave the company an immediate and powerful footprint in Alberta and Saskatchewan, effectively diversifying its geographic risk and providing a new engine for growth. Throughout the following decade, the company experienced a period of steady, incremental expansion. As the number of restaurants in the royalty pool increased each year, the total income grew in tandem with the Canadian quick-service restaurant industry. The stability of these dual streams was tested during periods of economic fluctuation, yet the essential, value-oriented nature of the product consistently supported consumer demand. Even as the corporate structure evolved from a trust to a corporation to meet new regulatory requirements, the underlying mechanics of the revenue generation remained focused on capturing a percentage of every order placed through their proprietary call centers and digital platforms. In more recent years, The company has navigated a complex landscape marked by rapid digital transformation and global health challenges that briefly disrupted traditional dining patterns. However, the business model proved its durability as sales migrated quickly to delivery and pickup channels, allowing the royalty streams to recover and eventually surpass previous heights. The brands have continued to modernize, integrating advanced order processing technology that supports system-wide sales efficiency. As the company enters its third decade of public trading, it remains anchored by its core Canadian markets while beginning to eye international potential, ensuring that its revenue streams continue to reflect the broad reach of two of the country's most enduring food service trademarks. The financial history of Pizza Royalty presents a masterclass in the asset-light business model, characterized by an exceptional conversion rate of revenue into cash flow. By analyzing the progression from top-line revenue to free cash flow over the last 2 decades, several critical themes emerge regarding the company's resilience, structural changes, and focus on shareholder value. At the core of the table is the revenue stream, which is derived from a fixed percentage of system-wide sales. This top-line income is remarkably stable because it is not impacted by the operational volatility that plagues the typical restaurant industry. While a standard restaurant must grapple with the rising costs of ingredients, the pressure of labor wages, and the overhead of rent, this corporation is insulated from such factors. Consequently, the cost of goods sold and research and development expenditures remain consistently non-existent. The company does not produce dough or develop new menu items. Instead, it licenses the intellectual property that allows others to do so, receiving a first dollar cut of every pizza sold. The administrative burden of maintaining this structure is surprisingly lean. General and administrative expenses represent only a tiny fraction of total revenue, typically covering the costs associated with being a public entity, such as legal fees, audit requirements, and director compensation. This high-margin efficiency ensures that nearly every dollar collected from franchisees flows directly toward the bottom line. The most significant shift in the company's financial obligations occurred roughly midway through the historical period, following a change in Canadian tax legislation. Previously operating as an income trust that was largely exempt from certain taxes at the entity level, the company transitioned into a corporate structure. This change introduced a consistent income tax provision into the ledger, creating a permanent gap between the total revenue collected and the final cash available for distribution. Despite the introduction of corporate taxes, the company's operating cash flow has remained a reliable engine for dividends. Because the business model does not require reinvestment in physical kitchens or delivery vehicles, responsibilities that fall entirely on the operational parent and its franchisees, capital expenditures are effectively zero. This leads to a unique scenario where operating cash flow and free cash flow are virtually identical. Unlike technology or manufacturing firms that must frequently set aside cash for equipment or software development, this entity can afford to distribute almost all its earnings to its investors. The financial architecture of Pizza Royalty is designed with a singular, laser-focused objective: the efficient conversion of top-line restaurant sales into consistent shareholder distributions. When examining the allocation of capital over the past 2 decades, the most striking feature is the near-total symmetry between free cash flow and dividend payments. This is not a company that hoards capital for speculative ventures or massive internal expansions. Instead, it functions as a high-yield pass-through vehicle, where the owner earnings are returned to the market with remarkable regularity. In the early years of the historical record, the company's capital activity was dominated by a transformative strategic move. By utilizing a combination of cash reserves and increased debt facilities, the entity acquired the rights to a major regional competitor in Western Canada. This acquisition was a rare departure from its typical passive stance, representing a deliberate effort to diversify the royalty pool geographically. Beyond this singular event, the company has largely avoided major acquisitions, preferring to grow organically as the operating parent company opens new franchise locations. This organic growth requires no capital outlay from the Royalty Corp itself, creating a virtuous cycle where the asset base expands while the corporate treasury remains unburdened by construction or development costs. The company's approach to the balance sheet is characterized by a low-churn philosophy. Unlike many modern corporations that engage in aggressive share buyback programs to manipulate earnings per share, this entity maintains a very stable share count. This lack of stock-based compensation further ensures that the interests of the common shareholders are not diluted, allowing the full value of the royalty income to remain accessible to the public float. Debt management within the corporation is similarly conservative and structured. The financing debt consists primarily of fixed-term bank loans used to facilitate initial growth or structural transitions. While the absolute level of debt stepped up significantly following the major Western Canadian acquisition and subsequent corporate reorganizations, it has since remained remarkably static. The company does not carry the typical operational liabilities of a restaurant chain, such as heavy lease obligations for kitchens or equipment. Those burdens sit with the franchisees and the operating parent. Consequently, the debt shown on this balance sheet is purely financial in nature, supported by the highly predictable and recurring nature of the royalty checks. The interest coverage remains robust because the top-line nature of the revenue ensures that debt servicing is the first priority after taxes and minor administrative costs. Ultimately, the capital allocation narrative of this company is one of extreme transparency. Investors choose this stock specifically because they know exactly where every dollar of profit is going. The lack of capital leakage into research, development, or unnecessary administrative growth means that the bridge from revenue to the investor's pocket is one of the shortest in the Canadian capital markets. By maintaining a fixed debt profile and avoiding dilutive share issuances, the company has successfully protected the per-share value of its trademarks through 2 decades of varying economic climates. It stands as a testament to the power of a simplified business model that prioritizes the return of capital above all other corporate ambitions. The leadership and ownership structure of PZA.TO Royalty Corporation reflect a seamless transition from a family-founded legacy to a professionally managed public entity. Paul Goddard currently serves as the Chief Executive Officer, a role he has held since early 2010 following the passing of the company's founder, Michael Overs. Goddard originally joined the organization in 2009 as the Chief Information Officer and Vice President of Enterprise Development. His background as a mechanical engineer with an MBA from London Business School provided a technical and strategic foundation that helped modernize the brand's digital infrastructure during his early tenure. The company is primarily owned by the general public, with retail and individual investors holding approximately 82% of the outstanding shares. Institutional investors account for roughly 17% of the remaining ownership. Individual insiders and board members maintain a modest direct stake, often cited below 1%. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. The bull case optimistic trajectory for the company hinges on a successful transformation from a Canadian staple to an international contender. In this vision of the future, the recent entry into Mexico serves as a springboard for a broader Latin American presence, while domestic operations benefit from a second wind driven by advanced AI-integrated delivery logistics and a premiumization of the menu. The primary catalyst here is the aggressive addition of high-volume international locations to the royalty pool, which allows the company to break out of its historical low single-digit growth patterns. By maintaining its lean administrative structure even as the top line expands, the business would generate significant excess cash, potentially funding the acquisition of another regional quick-service brand to further diversify the royalty streams beyond pizza. Under the most likely path forward of a base case, the company continues to mirror the steady, dependable growth of the Canadian population and inflation. This middle ground assumes that the brand remains a dominant value player in Ontario and Western Canada, successfully defending its market share against global giants and trendy newcomers alike. The catalyst for this stability is a continuous cycle of modernizing existing storefronts and expanding into non-traditional venues like transit hubs and smaller suburban communities. In this environment, the business remains a dividend machine, where nearly every dollar of royalty income is passed through to investors, and the lack of capital expenditure remains the company's greatest competitive advantage in a world of rising operational costs. Conversely, A more difficult future of a bear case could emerge if the brand faces a persistent decline in traditional pizza consumption or fails to keep pace with digital competitors. In a saturated market where consumer preferences shift toward healthier alternatives or artisanal competitors, the company might see its same-store sales stagnate or slightly contract. The primary risk in this scenario is a margin squeeze, not at the royalty level, but at the franchisee level. If restaurant operators struggle with skyrocketing labor and rent costs, the parent company may be forced to slow the opening of new locations, causing the royalty pool to flatten. While the company's lack of debt and fixed costs provides a strong safety net, the growth in payouts would likely stall, turning the stock into a bond proxy that relies solely on its current yield rather than any future appreciation. In the bull case scenario, we assume the following: revenue growth at 5.5%, operating cash flow margin at 78%, capex growth at 0%, stock-based comp growth at 0%, dividends growth at 6.5%, stock repurchase growth at 0%, acquisition spending in the next 20 years at $100 million. Stock repurchases assumes price-to-sales ratio of 9. With this discounted at 7%, dividend model yields $12 worth of value per share in 20 years, $18 in 30 years, and $23 in 40 years. In the base case scenario, we assume the following: revenue growth at 2.5%, operating cash flow margin at 75%, capex growth at 0%, stock-based comp growth at 0%, dividends growth at 2.6%, stock repurchase growth at 0%, acquisition spending in the next 20 years at $0 million. Stock repurchases assumes price-to-sales ratio of 9. With this discounted at 7%, dividend model yields $9 worth of value per share in 20 years, $11 in 30 years, and $12 in 40 years. In the bear case scenario, we assume the following: revenue growth at 0.5%, operating cash flow margin at 72%, capex growth at 0%, stock-based comp growth at 0%, dividends growth at 0.5%, net stock repurchase growth at 0%, acquisition spending in the next 20 years at $0 million. Stock repurchases assumes price-to-sales ratio of 9. With this discounted at 7%, dividend model yields $7 worth of value per share in 20 years, $8 in 30 years, and $9 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.